Is Islamic mortgage really different, or just rebranded interest? Just a new name. This question is causing growing controversy within both financial circles and the Muslim community. Some say Islamic banks have created a halalified version of mortgage that mirrors conventional credit in every structural detail. Others insist the foundation is spiritually pure. So today, we're diving deep into Islamic mortgage credit systems. Are they truly Shariah-compliant? Or are they structurally indistinguishable from regular bank loans, apart from how the profit is labeled? Let's uncover the gray zones and break the silence around the most debated Islamic finance product. The need for housing credit in Islamic societies. Buying a house is one of the biggest financial decisions in anyone's life. But for Muslims striving to follow Sharia principles, the conventional mortgage market presents a dilemma. Traditional banks offer interest-based loans, something clearly prohibited in Islam. This has created a strong demand for Islamic alternatives to mortgages that align with faith-based values. Enter Islamic banks, offering tools like Murabaha, Ijara, and Diminishing Musharaka as paths to homeownership without interest, Riba. On the surface, these models appear to provide a religiously acceptable solution. But dig deeper, and you'll find many practices that look and feel exactly like regular mortgage loans, prompting critics to ask, is this just interest in disguise? The strongest argument for Islamic banks is that they fund real items, not debts, free accounts, trade credits, and consumer credits. This covers unsecured funding needs, since the funds might be used for non-halal purchases. This is a clear and good motivation. However, once credit is allocated to specific purchases, such as houses or cars, the argument seems to collapse. Common structures used in Islamic mortgage. Islamic banks typically use three structures for housing finance. 1. Murabaha, cost plus sale. The bank purchases the property and sells it to the buyer at a marked-up price, payable in installments. The profit margin is fixed and known at the beginning. No formal interest, but the final repayment value is more than the original purchase. 2. Ijara, leasing. Here, the bank buys the house and leases it to the client. The customer pays rent until the lease term ends, at which point ownership is transferred. The lease amount typically mimics monthly mortgage payments. 3. Diminishing Musharaka, declining partnership. This is perhaps the most commonly used. The bank and client form a partnership to buy the property. The client slowly buys out the bank's share over time through monthly payments, while also paying rent for the part they don't yet own. These models are marketed as Shariah-compliant because they avoid direct lending with interest. But to many observers, they replicate the outcome of a conventional loan. And this raises a big question. If the outcome is the same, does the structure really matter? The core controversy, interest versus profit. Islamic authorities are clear. Riba, interest, is prohibited. However, profit on trade or services is allowed. Interest is the bank's profit. The problem may stem from the notion of interest, riba, itself. Modern interest may not be the same as the prohibited kind. So when an Islamic bank charges a markup on the sale of a house in Murabaha or a rental fee in Ijara, it's technically not interest. The bank is earning profit from a sale or lease, not from money lent. But here's the gray area. The markup or rent is often indexed to the same benchmark as interest rates, such as LIBOR or central bank rates. So while it's labeled as profit or rental income, it fluctuates exactly like interest does. This blurs the line between permissible and impermissible. Many critics argue, if you're using the same rate, over the same term, for the same asset, how is it truly different from riba? The defenders counter, it's not about the outcome. It's about the structure and risk sharing. But in practice, Islamic banks often avoid taking on any real risk, which is another point of contention. Islamic finance emphasizes risk sharing as a main point. Theoretically, the bank should share in the risk of the asset it helps you acquire. In Diminishing Musharaka, for example, the bank co-owns the property and therefore should share risks like property damage or market depreciation. What is the risk of house damage in real life? In the regular mortgage system, credit contains insurance as an obligation. Yes, regular banks also share the risk. Is there a meaningful difference between the two systems? But in practice, contracts are structured to transfer all the risk to the customer. If the house burns down, the customer is still liable. If the market crashes, the repayment amount doesn't adjust. If the buyer defaults, foreclosure follows, just like in a conventional mortgage. So the promise of shared risk often doesn't hold up. Who really profits, service or interest? Let's talk profits. Conventional banks earn interest income, a return purely for lending capital. In contrast, Islamic banks say they earn service income, profit from trade or lease, not from lending. But here's the catch. The Islamic bank never actually lives in or uses the house. The asset is often only held by the bank for a split second, then transferred to the buyer. The client is often responsible for maintenance, taxes, and insurance, indicating effective ownership from day one. This raises the question, what service is the bank providing beyond financing? Critics argue the bank is essentially selling money, just using a different label. Meanwhile, supporters maintain that these transactions avoid the exploitative nature of Riba, even if they mirror conventional models in appearance. Ultimately, it comes down to intent and perception. Is it halal finance that creatively navigates modern needs? Or cosmetic compliance that mimics interest under Shariah-friendly terms? Market realities, affordability, and access. Another criticism is that Islamic mortgage options are often more expensive than conventional loans. Because of their complex structure and legal layering, Islamic banks charge higher fees or markups. This creates an affordability gap. In some regions, Muslim homebuyers are forced to choose between cheaper conventional loans or more expensive Shariah-compliant ones. Many end up opting for the cheaper route, despite religious concerns, because Islamic options feel like a luxury, not a necessity. This is ironic. A system meant to protect the community from financial exploitation ends up pricing them out of homeownership. It raises questions about whether the current implementation truly fulfills the maqasid al-Shariah, the higher objectives of Islamic law, which include justice, welfare, and ease. Final reflection: halal housing or halal hustle? Let's be honest, Islamic mortgages sit in a controversial gray zone. Yes, they're structured to avoid interest and form. Yes, they're reviewed and certified by scholars. But in function, they closely mimic conventional loans, raising questions that deserve open, respectful debate. If Islamic finance is to thrive and build credibility, it must do more than repackage conventional models. It must offer authentically different, ethically grounded alternatives that serve the needs of modern Muslims without compromising core principles. As consumers, we also have a responsibility to ask tough questions, to demand transparency, to ensure our choices align not just with fatwas, but with faith. Because at the end of the day, the goal of Islamic finance isn't to look halal, it's to be halal in spirit, structure, and outcome. Ultimate statement: having a separate home is not a luxury for individuals or households. No religion can promote dependency on others for basic humanitarian needs such as shelter. Funding the purchase of homes for middle and low-income owners is a valuable service in humanitarian terms. If Islamic banks don't carry out this service based on the logic of charity, it is a trade. And trade is trade. Both systems are halal because they serve humanity with acceptable and agreed margins. It doesn't matter whether it's called interest or profit margin. What's your experience with Islamic home financing? Do you feel the system is truly different, or just dressed up like its conventional cousin? Drop your thoughts below, especially if you've worked with these contracts yourself. Don't forget to like, subscribe, and hit the bell to keep learning with Islamic Finance Unboxed.